welcome. My name is Karen Bullen, and what we're going to do in this lecture is we're going to have a look at the changes to capital taxes following the Finance Act 2013. So let's start off with capital gains tax changes. The annual exemption has gone up a little bit. It's now 10,900, but you just look at your tax tables in the exam to see what it is. The other change for CGT is to do with entrepreneurs' relief. Now, normally, to get entrepreneurs' relief, if you're a shareholder, you need to be a shareholder who works for the company and owns at least 5% of the shares, and you've owned the shares and you've worked for the company for at least 12 months prior to the disposal for which you're claiming entrepreneurs' relief. Now, what the changes have done is they've said that if you acquired your shares under an EMI scheme, then you can qualify for entrepreneurs' relief regardless of the percentage of your shareholding. And when we're looking at the ownership period, so you've got to have had those shares for 12 months, then that period is going to start on the date the option was granted to you, not the normal date when you acquire shares, which is the date the option was exercised. So for EMI schemes, it's going to be easier to get entrepreneurs' relief, to qualify for entrepreneurs' relief now following these changes. So these changes are for shares that you've acquired on or after 6 April 12 that are being sold on or after 6 April 13. So any shares being sold in our tax year, you're going to be thinking about these new special rules if those shares were acquired under an EMI scheme. So that's CGT. But the main changes following Finance Act 13 is to do with inheritance tax. Now, the first change I want to have a look at is to do with liabilities and deducting liabilities when you're looking at the net value of someone's estate before you charge inheritance tax. Now, what we do is, normally, we take the liability and we deduct it from the asset on which the liability has been incurred. So, for example, let's say that I run a business and I need to take out a loan for my business, but the bank a bit reluctant to lend me some money, so they say, look, secure the loan against your home, and you think, right, fair enough, she'll do that. So then that individual dies. Now, what we would do is the loan has been secured against the home, so the liability will be used to reduce the value of the home. And even though we use the loan to buy business assets, we don't have to deduct the liability from the business assets because we deduct it from the asset against which the loan was secured. And so in our debt estate, we're also going to have the business assets. Of course, business assets, you can claim business property relief. So this is the scenario that Finance Act 13 is trying to prevent. And so for loans taken out on or after 6 April 13, instead of looking at the asset against which the loan is secured, rather you look at what the loan was used for and deduct it from that part of the estate. So in my previous example, where my business loan was secured against my home, I'm not going to deduct the liability from my home, so the full value of my home goes into my debt estate. Instead, I'm going to deduct the value of the loan from my business assets. And those are the assets against which I was going to get BPR. So now the value of those assets against which I get BPR are lower. And so overall, I've got a much bigger taxable estate following the change in this rule. The second IHT change is all to do with non-dom spouses. Now, if you look at the second point on the slide, we've got a rule that says if you have assets going from one spouse to another, that's an exempt transfer for IHT. But if it's going from a UK domiciled spouse to a non-UK domiciled spouse, then the amount that is exempt is limited. Now, that limited amount used to be £55,000. But following the Finance Act 13, that £55,000 has been uplifted to an amount equal to the nil rate band. Okay, super, so 325,000. The second change for IHT is that a non-domiciled spouse is allowed to make an irrevocable election to be treated as UK domiciled. Now, if you are a non-dom, we only tax you for inheritance tax on your UK assets. Your overseas assets escape the charge to inheritance tax. Okay, let's have a look at an example involving this new irrevocable election. Let's say we've got Simon, UK domiciled, married to Yasmin, who is not domiciled in the UK, and they've got 2 children. Now, Simon died in this tax year, leaving an estate of £5 million to Yasmin. Now, the normal rule is we can't say all of that transfer to the spouse is exempt because Yasmin is a non-dom. It's going from a UK dom to a non-dom. So only £325,000 of that transfer is exempt. The rest of it is going to remain taxable in Simon's death estate. Now, he has made no lifetime transfers at all, so he does have a nil band available to offset against that. Yasmin herself has overseas assets worth £1.5 million, which she plans to leave to the children. Now, those assets are overseas, and she's a non-dom, so those assets would not be caught to UK inheritance tax if that happened. So, normal rule is, Simon dies, death estate is £5 million, he leaves everything to the spouse, but because the spouse is a non-dom, only £325,000 of that transfer is exempt from IHT, leaving us with 4.675 taxable, but we can reduce that taxable amount by the available nil band for Simon. Simon made no lifetime transfers, so all of his nil band is available, leaving us with 4.35 taxable at 40%, so £1,740,000 of inheritance tax to be paid out of the estate. Now that's going to go out of the estate, which of course, remember, all of that estate is going to Yasmin. Now let's say, unfortunately, Yasmin dies soon after. Now she's a non-dom, so we're only going to tax her on her UK assets. So the UK assets she's got are what's left of Simon's estate after the tax was paid. So it's 5 million minus the tax, so we're looking at 3.26 million. Now Yasmin has a nil band, so what's left after the nil band is taxable at 40%. So what the children are going to get is what's left of the UK assets after the tax is paid, plus the overseas assets, so just over £3.5 million worth of assets. And that's the normal rule. But Yasmin is allowed to make an election to say that she wants to be treated as a UK domiciled person. Now, first impact of that is if Simon dies, UK domicile, leaving everything to his spouse, UK domicile, the full amount of everything that's transferred to the spouse is exempt. So we'll be looking at a full exemption and nothing left taxable in the estate for Simon when he dies. It also means that Simon didn't use his nil band when he died. And so when we come to Yasmin's death, she can have her nil band plus Simon's unused nil band as well. But she's going to be taxed on her worldwide assets because she's asked to be taxed as a UK dom. So we'll be looking at 6.5 million of assets, less 2 lots of nil band at 40%, just over 2.3 million of tax, which means the children are going to get all of those assets, UK and overseas, less the tax, 4.1 million. So when you compare the two, without an election, in this example, the children actually ended up with less because there was a larger charge to tax. With the election, the children are getting much more of the assets because there's less tax being paid. Now, obviously, it won't always work in that way. Sometimes the election will be beneficial, sometimes it won't be beneficial. You'll need to compare the two scenarios if you get that sort of thing in the exam. It's an irrevocable election, so you can't change your mind. Once you've said I'm UK dom, you're going to be treated as UK dom for IHT. It's got to be made within 2 years of the death of the UK dom spouse. But there is a get-out clause, because this election automatically ceases once the electing spouse has been non-resident in the UK for at least 4 consecutive tax years. So they leave the UK permanently. Once they've been out of the UK for a certain period of time, then election goes, and the assets that are outside the UK are not going to be caught to UK inheritance tax. So, I hope you have found this update interesting and useful for you in the exams. I wish you all the best in exams going forward. And as I said, my name was Karen Bullen. You've got my email address there if there's any issues you'd like to raise with me or ask any questions in respect of this talk. Take care.